Hello guys, I hope everybody is doing good. I'm today doing a very short video on a very important topic on your FRM level 2 exam. In the FRM level 2, you have the liquidity risk management book, and in that there is a chapter called liquidity risk where there is a concept of funding liquidity risk, very important from the exam perspective, and it also has three case studies. So I'm going to cover those three case studies also and the basics of the funding liquidity risk in today's discussion, and three case studies also what I'm going to cover today. Okay, so first let us understand what is funding liquidity risk. Now a lot of people, okay, who have already read FRM, okay, level 1, they know that liquidity is nothing but whether when you have sufficient amount of money or not. Now within that liquidity risk there are two components. One is the funding liquidity risk, second is trading liquidity risk. Now over here we are going to be only focusing on the funding liquidity risk. So what exactly is that? When you do not have sufficient money to meet the requirements of the bill or the cash payments, that is called as funding liquidity risk. Now this might happen because there is a timing mismatch. Now for example, I am supposed to pay a bill and I'm also expecting some money to come to me, but that bill payment is coming first and the money which I'm going to pay or money which I'm going to receive is coming later. So there can be a timing mismatch. Okay, so remember that part. So funding liquidity risk is nothing but the firm does not have the ability to meet the cash payment requirement as they become due. One of the major requirement is because of the timing mismatch. This is the first one. Second, and this is also one of the major reason that is happening, that has been the case study requirement, is that there is the asset illiquidity. So I have the asset available, but I cannot convert it into cash immediately, and because of which I'm not in a position to pay back the amount. Okay, so there could be a asset liquidity issue, there could be a timeline mismatch issue. Further, the funding maturity. Now what is funding maturity? I have the asset available which is going to give me some cash flow, but yes, that cash flow is going to come after some time. So this is slightly connected to timing mismatch, but over here when we are talking about funding maturity, we are explicitly trying to understand there is some funding which is going to come to me from say other banks, but it is not going to come immediately, and hence I'm not in a position to pay back the obligation which has to be paid on an immediate basis. Okay, now we'll go more in detail. So there are three primary drivers for this risk. What is this risk we are talking about? Funding liquidity risk. Okay, and from the exam perspective you should know all three properly. The first one, weak financial performance. Now majority of the times the companies are not able to pay back because their business is not doing good, so they are not able to generate cash internally, and hence they are not able to pay any obligation. It can be bond obligation, payments to their other creditors, payments to trade creditors, they are not able to pay. Okay, so this is the first reason. What is that? Cannot generate cash internally. The second one, hesitant investor. Now think about this. If suppose there is a news in the market that your company is not doing good, how will other banks or other financial institution will give you money? Very difficult, right? So when other investors who can provide you liquidity, they are hesitant. Okay, so the external funding, okay, the wholesale banking funding that might come to you has now gone. Okay, so hesitant investor is also one of the main reason. Next, and very important, funding decision. Now I will be talking that also in detail in the case studies, one of the case studies, that the short-term funding and long-term need. So there is a deliberate mismatch, okay, which is also called as asset liability mismatch. I have raised money for a short period of time and I've utilized that money to create an asset for a longer period of time. Okay, that is a third reason, that is a funding mismatch or a funding decision mismatch. And there is one more interesting point which is there in your curriculum also, which I've covered in the side. What is that? The intuition. Now the solvency and bankruptcy is two different things. Okay, so I might have the solvency, that means I might have the asset which is available, which is more than the liability which is supposed to be paid. Okay, but those assets might not be liquid. So even though on paper I am solvent, even though I have more asset as compared to the liabilities which I'm supposed to pay, but because those assets are not liquid, I can become bankrupt. So solvency is a very different concept and bankruptcy is a very different concept. So remember that for the exam. Okay, and I'm marking this as star. Okay, let us go to the next part, predictability. Now why we are talking about predictability? Whenever we think about liquidity, okay, we need to be very clear when the money has to be paid, when the money is going to come. Okay, so what companies generally do, whatever the cash inflows, okay, they are going to get, or whatever cash outflow that I'm going to make, they try to judge it on the basis of how much predictable it is. For example, look at them. Okay, coupon payments, debt maturity. I know with more clarity that when this is going to happen. So if I have purchased a bond, I know when the coupon is going to come. If I have issued a bond, I know when the coupon has to meet. So there are certain cash flows which are very predictable in nature, and hence it helps you to map your liquidity properly. But there can be certain ones where you have no control. For example, look at the customer withdrawal. So for example, depositors moving out of the bank, you do not have clarity when they will take out the money. It can be because of some other bank giving them high rate of returns, or it can be because of some bad news about your bank. Correct? Next is margin call. Okay, in a derivative position, okay, today you might be in profit, but tomorrow you might end up being loss. When you are in loss, you have to give the margin call, and that margin call can be very, very huge. Credit line drawdown. So you have given line of credit to your customers. Okay, suppose I've given a line of credit to one of the businessman of around 10 crore rupees, and when he is facing a problem, he can come to bank and withdraw that 10 crore rupees without any much of the documentation, because I have given him the line of credit. Now there are variations into it, committed, non-committed, but what I'm basically trying to help you understand, that those withdrawals can happen immediately, and because you have given a line of credit, you cannot stop it. Okay, so they are unpredictable. So what this slide actually tells you, whenever you are looking at any liquidity, okay, or your ability to pay, you have to understand what are the different cash flows that are there, how many of them are predictable, how many of them are not predictable. Okay, so that is very, very critical. Okay, let us move to the next part. When we talk about the source of liquidity, okay, this is basically telling you that, okay, when we are talking about cash flow, from where the cash flow can come. So we are now looking at both the asset side and the liability side, and this is there in your curriculum in the book. Okay, look at first the asset side. Okay, now asset side means, first, very simple thing that any company would have is that what are the amount of cash bank balances that I have that I can utilize. Second, do I have treasury instruments which are highly liquid? Okay, treasury instrument which are highly liquid. Now which can be easily converted into sale. Okay, or it can be easily converted to cash, and that will help me to pay back my bills. Correct? So first is cash and treasuries. Now I have explicitly added one point. Can you see that? Which is high liquidity is equal to low return. Now what many banks can think that, okay, if I want to protect myself against liquidity, let me keep majority of my money into treasury. But my friends, the problem that you're going to face is that you will get very high liquidity, but the return that you're going to generate is very low. And at an overall business level, when you look at the return on equity or return to shareholder value, that is not going to give you any benefit. Okay, so even though it is highly liquid, it might not give you return. Okay, look at the second thing, which is trading book liquidation. Now any bank, they have a banking book and the trading book. Banking book is where the assets are generally held till maturity. Okay, so all the loans, all the major big investments will be in the banking book. But what about the trading book? Okay, trading book is the book where I'm going to keep those assets which I'm going to hold for a very short period of time. Okay, because I've just invested and I might sell it. So now if suppose tomorrow there is a huge pressure of liquidity on the bank, I can immediately liquidate all the assets that I have in my trading book. Okay, so selling asset from my trading desk, right? But the problem is, when there is a crisis in the market is going down, and you're also selling your assets, you might be able to sell, but at a very low price. Okay, so it depends on whether you have a good market. If the market is not good, your selling could be a fire sale, which means everybody else in the market is selling and you're also selling, and you might not get a good price. Okay, so this is the second point, which is trading liquidity book. Okay, the trading book liquidation. The next, and also very interesting, connected to your level 1, is securitization. Okay, now there are certain assets in my balance sheet which I can remove and create a pool, and I can sell it to the investor and bring liquidity. Okay, so if you remember in level 1, there was a concept of mortgage and mortgage-backed security. There was a chapter on that. Then you have the overall concept of CDO, CLO. All of this basically works on very simple concept. You are taking up certain illiquid assets from your balance sheet, creating a pool, and on that pool you're creating one more instrument, which is say MBS, and you're selling those MBS to the market, and hence when you sell, you get liquidity back. Okay, so this was a very good source, okay, for the banks to generate liquidity before 2007. But now after 2007, because one of the reasons of the 2007 crisis, the subprime crisis, was basically that the pool started underperforming and the value of those assets started going down. Okay, so that is the overall thought process that I basically find in the asset side. Now let us go into the detail from the liability side. Okay, now for a bank, the liability is the deposit, because I have taken the money from the bank but I have to give it back, correct? So what is the liability side source of liquidity I can get? Okay, so I can get new customers. I can basically engage into those customers who can keep their money for longer period of time with me, because if the money is stuck with me for longer period of time, I will have that liquidity available. Okay, so I can attract more retail investors, wholesale investors, correct? But again, they are very sensitive to interest rate change, especially the retail customers. If they find any other bank giving you slightly higher return, they might immediately go out, correct? Now, and also see, because it's a saving account, so customers will transfer money, right? So when they will transfer money, your liquidity will go up, out, and there can be money also coming in into their account. So it's not very predictable, but yes, it provides a good cushion to the bank. And in Indian banking terminology also, we call it as CASA, current account, saving account, because that is the cheapest form of liquidity that the bank can generate. Okay, now if suppose tomorrow the liquidity tightens in the market, okay, because there is stress in the market and all of that, and then in that case what will happen, it is going to be very difficult for you to raise those current account and saving account fast, and hence you might not be able to generate cash or liquidity from the liability side. Okay, this is the first point. I'm going to move to the second, borrowing. Okay, now banks borrow money, not they get money not only from the depositors, they also borrow money from the interbank market, from bond market, debenture market, right? So all of this, so wholesale market when we talk about, okay, these are nothing but I'm trying to raise money, okay, through selling some instruments, primarily bonds. Then there is an interbank market. So Barclays is raising money from HSBC for a short period of time. Okay, the same thing can also happen in line of credit. So for example, Barclays, they want to raise money, so they can have a line of credit with, say for example, Bank of America or Deutsche Bank. Okay, and if there is a need for Barclays immediately, they can withdraw money or they can get money from some other bank. But interbank lending, where generally, for example, if you know LIBOR, okay, that's a London interbank offer rate, when one bank is borrowing from another bank for a very short period of time. Okay, it's a proper loan. Credit line is a product, okay, where I am basically having a commitment that I will give X amount of money to the particular bank. Okay, so borrowing can also bring in a lot of liquidity. So this is the liability side, the depositors and the borrowing part. Okay, the very infamous source for money is also available, which is the central bank borrowing. Now why this is interesting? Okay, say in India also, if you see the RBI, which is also issuing a repo and reverse repo rate. So repo rate is something where bank can give some asset to RBI and raise money from RBI. Okay, but the problem is that if the asset is not of a good quality, what will RBI say, or what will the central bank say? Okay, I can give you money, but you have posted me an asset of $100, it is illiquid, I will not be able to give you entire $100, I will give you $90. So there is a 10% haircut. Okay, 10% haircut that might apply. Okay, secondly, okay, the rate of interest could be slightly higher than what the bank could have got from the depositors. Okay, so overall there could be slightly higher rate of interest from the banking central bank perspective. And very big problem is that if suppose this news goes out, okay, then there can be a reputation damage that yes, this bank is raising money from central bank, that means there is some problem. Okay, so you have to be very cautious. So borrowing from central bank can act as a stigma. Okay, now when we are talking about stigma, the market participant might take it in a wrong way, and this has happened in one of the case study that we are going to be covering now. Okay, that is why banks are not very keen on directly raising money from the central bank. Okay, because it can lead to a big reputation damage. Okay, so let me move to the case studies now, and these case studies are also highlighted in your curriculum. The first is Northern Rock. Okay, now Northern Rock is a classic case of asset liability mismatch. Now if you look at on the screen, what we have given you is the liability side and the asset side. Now what they did is they raised money for a short period of time. Now when you raise money for a short period of time, like say 90 days, 180 days, or even 360 days, once you reach that time, you have to roll over. Roll over means you have to either issue, for example, I am issuing commercial paper, which is a 180-day commercial paper. After 180 day, either I have to issue new commercial paper to pay back, or else the existing commercial paper holders I have to tell them that I will give you money after 180 days and I'll pay you the interest also. So they have to keep on rolling. Okay. So what these banks did, they raised money from a short period of time. Okay. And they invested money where? They invested into mortgages, which were kind of illiquid. They purchased a lot of MBS, mortgage-backed securities. Now, when there was a crisis, what happened? Okay, this entire liability side, which is the commercial paper, repo market, that market collapsed. And when we talk about this, the asset side, whatever MBS they were holding, they were not in a position to pay. They were not in a position to sell those MBS. Okay, because the market has collapsed. So now what is that? They're into catch 22 situation. They're not able to sell their asset to get the money, and they still have to pay the liability side. They still have to pay the liability side, right? So this created a complete pressure of liquidity on them. And this happened during the 2007 crisis. And during that period of time, the interbank lending market was not available. Okay, investor who had already given them money through commercial paper or repo, they were very hesitant. They didn't want it to roll over. They wanted their money back. Okay, and Northern Rock could not roll over. They had a funding problem because asset is not available and the liability holders are asking their money back. Okay, so timeline, if you look at the overall timeline, okay, so what Northern Rock did, they basically went to Bank of England and they raised money. How much? 3 billion pound. Okay, and BBC, they broke this news, and this created a panic in the market, and then the bank run happened. Okay, bank run means everybody started going to the bank and started withdrawing the money. Now, once this happened, even the government had to step in, the central bank had to step in, that they had to tell people that do not withdraw. There is a guarantee. We are there to protect you. But till that time, huge money had already gone out of the bank. Okay. And what happened? Then the regulator had to take stake in the bank. They had to nationalize the bank. So this is a very classic case that once problem of asset liability mismatch, the funding liquidity risk, can turn out into such a massive problem or massive issue or bank run that the government had to step in. Okay, so the lesson that we are learning over here is a conservative funding assessment. That means you matching the asset and liability as much as close possible could have avoided this problem. Okay, and what was the outcome of it? Bank was nationalized, management was fired. Okay, so from the exam perspective, you should remember these things. Further, there is one more interesting case study of Ashanti Goldfield, which is basically a gold mining company in West Africa. Okay. Now, obviously, if I am a gold mining company, I am always going to be afraid that the gold prices might go down when I have the gold available in the future because I want to sell it in the market, right? So to protect against them, what they did is they entered into a gold forward contract. Okay. They took a short position. Now, everybody knows if it's a short position, if the price goes up, there is a problem. But if the price goes down, that hedge will protect you. Correct. So they were basically thinking that the prices will go down, and they had an opinion that the prices are going to remain stable or low. But there was some market development. European Central Bank, they limit the gold sale, and hence there was a supply crunch, and immediately the price went up, and it went against their hedge of the short position. So there was a supply shock. Okay, if there is no supply in the market, the price automatically goes up. Correct. So it went up by 25%. Now they started facing problem. Okay, the gold which they are having, okay, in market, okay, first of all, whatever gold they are having, it will take some time to sell. Secondly, because it's a mine, the gold might come in the future, right? But all the forward contract that they have taken, they are in loss. And in OTC market also, if you are in loss in the forward contract, you have to put collateral. Okay, and they started getting margin calls. Okay, in OTC market, you have to put a collateral because if you are in loss, the other party can face a problem, right? So to take care of that, they basically started putting collateral, and whatever asset they were having, those assets were primarily illiquid, and this created an entire death spiral for that company. Okay, so Ashanti could not meet any margin call. They were forced to close out their hedge even at a very bad term, and ultimately they faced a huge loss in this entire thing. Okay, so what is the key lesson that FRM level 2 students should learn? Even if your assets create wealth, eventually immediate cash, that means liquidity, is very, very important. Okay, very interesting case study. Okay, Ashanti Goldfield. Metallgesellschaft, this case study was there in your level 1 also. Now basically they are a subsidiary of a Deutsche company, British German company, and they were based out of US, and they were basically selling oil. Okay, now what they did is they basically had a contract with their customers where they basically, and those contracts were long-term contracts, and they were in a position to sell oil to their customers and to protect against that fluctuation. Because if I'm in a contract and tomorrow the price goes up, I might have to buy from the market at a high price to service my customer. Okay, so they had, okay, long-term fixed price contract. Okay, and in that long-term contract, what were they doing? They were basically selling. So they had taken a short position. They had taken a short position in the long-term contract. Okay, but to protect them, what they did is they entered into the futures market. Okay, and they took a short-term contract, near month contract, 1 month, 2 month contract. Okay, and there they took long position. So what is now happening in the forward contract? They have taken a short position on a very long-term contract. Okay, and in the futures market, they had taken a long position on a very short-term contract, and the size of the contract was very, very huge. Okay, now when they entered into the market, the oil prices were low and the future prices were very high. So it was expected that the oil prices will go up and they will make money in the futures contract. But after some time, the oil prices went down. Okay, and when the oil prices went down, what happened? Okay, the oil prices were up, and the future price, sorry, oil prices went down and the future prices were up, and the future price has to come down and it has to touch. So now in their long futures contract, they started facing loss. They started getting margin calls and realized the original position was forward contract. It was a contract, right? And that contract is not going to give you money immediately. It was a 5-year, 10-year contract. So the money that you're expecting on the forward contract is going to come after 5-10 years. But in the futures contract, the margin has to be paid today, because future contracts are done M to M, mark to market, right? So it led to huge cash outflow from the company. Okay, and the long-term contracts were not giving them money immediately. Okay, this was the impact. Okay, and what happened because of this? The management panicked, the main parent company panicked. Okay, and they said, okay, whatever long position I have taken into the futures contract, let me exit. Okay, so they decided to liquidate their position. Okay, when they did the entire liquidation, how much was the loss? Around $1.3 billion. Okay, and again, if you look at the commonality between this and the Metallgesellschaft and the Ashanti, I have highlighted the 2 points very, very interestingly, which is that immediate cash flow was needed and they did not have that. Okay, and whatever asset I was having in the Ashanti Goldfield, it was the gold which was there, and the other case, which was basically the Metallgesellschaft, there you had a contract. All of them were illiquid. They were not giving cash immediately. So even though you're using a hedging instrument, you have to be very clear what is the liquidity impact of that. So Metallgesellschaft ignored that. They did not realize that my main original position is forward contract and the hedging instrument is basically a futures contract where there can be a liquidity issue. So they did not understand. This was a third case study, important from the exam perspective. Okay. Now, how to manage all of this? What generally companies, the regulators do? Basically, they ask banks to keep reserves. In India also, you have the reserve requirement. Okay. So in US, you have to keep minimum 10%. So whatever deposit is coming, some portion of that has to be kept in reserves, so that if tomorrow there is a problem, okay, you have enough liquidity. But there is an issue connected to it. Think about this, connecting it to the money supply in the economy. Right? What is the economic impact? Okay, if I am keeping the reserves very high, what will happen? The banks will have lesser money to lend, so money supply in the market will reduce. Similarly, if I reduce the reserve requirement, more money will be available with bank and they will be in a position to lend more, and hence the money supply will increase, and hence the inflation will also go up. So the regulator, okay, they have this tool of keeping the reserve requirement. It also connects to the money supply part. Okay, how do they regulate the overall money in the economy? Okay, so that's the overall section that we have covered, and I've just given some pointers, the last minute pointers. Okay, for people or student who are reading, they can make a note of it, these important pointers for that first section of that chapter. Okay, I hope you like this video and it helps you in your preparation. This is one of the important topics in your FRM level 2, and hence I've made this video. Okay, so thank you again for joining in.